Welcome back, Investing Alchemist family. This is your 9th episode, and we are continuing our exploration of essential terms in the stock market. In our last episode, we delved into concepts like portfolio and CAGR, primarily used for long-term investments. Today, our focus shifts to the TRM position, a crucial TRM in the trading activities. Position, simply put, refers to a trade you've taken. It's the specific stance you've adopted in the market. For example, you might say, I took a position in Reliance at 10 a.m. and it's currently in profits, so I plan to hold on to it for some more time. Moving on to terms every trader should be familiar with are trading capital and deployed capital. Your trading capital is the total amount you've added to your trading account for all your trading activities. If you've funded your account with 1 lakh rupees, that becomes your trading capital. On the other hand, deployed capital is the money specifically used for a particular trade. For instance, if you've taken a position in Reliance, and the capital deployed in that trade is 25,000 rupees, which is 25% of your trading capital. Now, let's touch on an important concept, position sizing. It emphasizes the significance of not deploying your entire trading capital into a single trade. If your total capital is 1 lakh rupees, you should only allocate a portion of it to a specific trade. This practice helps manage risk effectively. Moving forward, we encounter terms like long position and short position. A long position involves buying with the intent to sell later, while a short position is when you sell first with the intention to buy back later. Squaring off a trade refers to exiting it, whether it's a long or short position. For instance, I took a position in Reliance at 10 a.m. and squared it off at 2 p.m. Let's explore return on investment ROI, a percentage that measures how well a trade performed. The formula for ROI is the profit from a trade divided by the capital deployed in the trade. For example, I took a position in Reliance at 10 a.m., squared it off at 2 p.m., and the trade gave me an ROI of 2%. Next up is the contract note, a daily report from your broker detailing all the trades and associated charges in your demat account. It's crucial to review this document to track your trades, profits, losses, and brokerage charges. Now, let's touch on the concept of trend. In simple terms, trend is the general direction in which a stock is moving. It could be an uptrend, moving up, downtrend, moving down, or a sideways trend, staying within a specific range. Moving on to familiar terms, bullish and bearish. Bullish indicates a general uptrend, while bearish signifies a downtrend. For example, the market was in a bullish rally for more than a year after the crash during the COVID times. Understanding volatility is crucial. If a stock is volatile, it means it's not stable and makes frequent, significant moves in either direction. Meanwhile, volume refers to the number of share transactions in a given time frame. For example, today at 11 a.m., there was a huge volume in Reliance after news about its entry into the space industry. Now, let's delve into liquidity. High liquidity occurs when there's a substantial demand and readily available supply for a stock. Conversely, illiquidity indicates low demand and supply, making it challenging to sell a stock. Charts are graphical representations of a stock's price movement over time. Analyzing charts helps you understand trends and make informed decisions. For example, check the chart of Reliance, it looks bullish. Moving on, 52 weeks high or low represents the highest and lowest prices a stock reached in the last 52 weeks. It provides insights into a stock's performance over a year. Now, let's demystify upper circuit. The upper circuit is essentially an upper limit set for the price movement of a stock during a trading day. This limit is imposed to prevent extreme and rapid price movements, as well as potential market manipulation. Here's how it works. For non-F&O, futures and options, stocks, which are stocks where derivatives like futures and options are not activated, the upper circuit is fixed at preset levels, such as 5%, 10%, or 20%. This means that if the stock's price moves up to the specified percentage, it gets locked at that level for the rest of the trading day. Example, if a non-F&O stock has a 5% upper circuit, and its price rises by 5%, it gets locked at that level, preventing any further upward movement for the day. For F&O stocks, which are typically large cap stocks with high liquidity, the upper circuit is not a fixed percentage. Instead, it's commonly set at 10%. However, there's a unique aspect to the upper circuit in F&O stocks. After the stock hits the 10% upper circuit, it gets temporarily locked at that level. However, unlike non-F&O stocks, this lock is released after a certain duration. If there is continued buying interest, the stock can move up to 15%, then get locked again, and similarly move to 20%. This process allows for more flexibility in price movement. Example, if an F&O stock rises by 10%, it gets locked temporarily. After the lock is released, if there's sustained buying, it can move up to 15%, then 20%, and so on. Lower circuit. Conversely, the lower circuit serves as a lower limit for the price movement of a stock. It's designed to prevent stocks from plummeting to extremely low levels within a single trading day. Here's how it operates. Similar to the upper circuit, for non-F&O stocks, the lower circuit is fixed at preset levels, such as 5%, 10%, or 20%. If the stock's price drops to the specified percentage, it gets locked at that level for the rest of the trading day. Example, if a non-F&O stock has a 10% lower circuit, and its price falls by 10%, it gets locked at that level, preventing further downward movement for the day. For F&O stocks, the lower circuit is typically set at -10%, and the mechanism is comparable to the upper circuit. After hitting the -10% lower circuit, it gets temporarily locked, and if there's sustained selling, it can move further down to -15%, then -20%. Example, if an F&O stock drops by 10%, it gets locked temporarily. After the lock is released, if there's continued selling, it can move down to -15%, then -20%, and so on. Lastly, we touch on gap up and gap down openings. These occur when the opening price is significantly higher, gap up, or lower, gap down, than the closing price of the previous day. This creates a visible gap on the price chart between the closing price of one day and the opening price of the next day. Remember, the closing price is not necessarily the same as the last traded price, LTP, at 3:30 p.m. It's determined as the average price of the last 30 minutes of trading, with weightage given to volume. I hope this session has clarified these essential terms. Remember, the more you understand, the more confidently you can navigate the stock market. Smash that like button if you found this helpful. Subscribe to Investing Alchemist. Until next time, happy investing, trading, and growing together.